Good afternoon, everybody. Welcome to TraderMerlin Show for your Tuesday afternoon edition. Hope you had a fantastic trading session. We had some nice moves out there. We'll cover all these different markets in just a second. But again, a quick shout out to everybody. Welcome to January of 2022. All right, so I see John says, I'm thinking Santa left some of the tech toys at the workshop. Yeah, it was interesting how we saw a split in indexes in that Santa Claus Rally window of time. So to start things off, if you don't follow me on Twitter, I don't really post that much other than to promote the show. I am a horrible social media person. I should get much better at it if I ever expect this show to grow and maybe become something much bigger. But as it is right now, I just tweet out every now and again something that I find interesting. So if you do follow me, I did a poll. And I did a poll December 25th, which was asking, do you think there's going to be a Santa Claus Rally? Now, of course, you guys are all regulars, so you know that a Santa Claus Rally for most people is very ambiguous. Well, when does it start? When does it end? Most people just say it's Christmas Rally. Trader's Almanac, who we've had Jeffrey Hirsch of Trader's Almanac on this program before, great guy. His father, Yale Hirsch, kind of started Stock Trader's Almanac. And their perspective is, through analysis, that there's this window of time, which is the last 5 days of the trading year, plus the first 2 days of January. So 7 trading days altogether that make up the Santa Claus Rally. And over the course, I think since 1950 or something like that, it averages about 1.5%. So I made a poll and I said, well, what do you guys think? Do you think it's going to be from 0 to 1.4%, meaning no real Santa Claus Rally? 1.5 to, let's say, 2.9, meaning yes, good Santa Claus Rally? Above 3%, meaning yes, we're rocking? Or we're going to go negative, lumps of coal for Christmas. So here are the results of that poll. I'll bring them up for you, and we can see that I have maybe a ominous picture of Santa here after a little bit of a bender. I'm sure this is probably Santa on December 26th after he's just like, I'm done with this. But if we go there, and it was 1950, that's what I thought. So here's the poll I did, and you can see that the winner in this, at least what was the most selected at 35%, was yes, we were in fact going to have a Santa Claus Rally for those 7 trading days. 1.5 to 2.9 was the general consensus. I actually put nope. I thought it was going to be less than 1.4. I thought we'd see a very muted holiday. I was kind of right, because the correct answer was nope, not more than 1.4%. So it's kind of challenging here, because if we look at the market index, I personally use S&P 500 for whenever I say the market, that's what I'm looking at. And I think Trader's Almanac does as well. However, many of you might be looking at the Dow, the Nasdaq, the Russell, S&P, different ones. So let's look at what they all did to get a greater sense as to where the Santa Claus Rally was and who got lumps of coal for Christmas. There we go. So if we look at the market results, we'll start at the bottom here and work our way up. So number 1 was the Nasdaq 100. And really, if you look at what caused this Nasdaq, it was today. Here is a chart of the Nasdaq 100 so you guys can see what happened. Really, today's trading activity erased all the gains for that 7-day. Granted, we were drifting down ever so slightly in the triple Qs. I guess I should put the triple Qs up here, not the futures. Here we go. So there you can see the red line from where we opened that 7 on December 27th to where we closed today. It is showing a total of down 0.44%. So not the best. Again, I still think the markets look great. I think they're just in a consolidation pattern right now, so nothing to worry about. But in fact, we did not get a Santa Claus Rally for the Nasdaq. As I saw earlier, John saying, Santa Claus left out some tech stocks. And you can probably thank Tesla. Here's Tesla for today, which we'll talk about maybe a little bit later on. A nice island reversal, buy the rumor, sell the news kind of story with Tesla, who had phenomenal news yesterday. Then you look at Apple, who had the record-breaking all-time highs, $3 trillion market cap, and then, we got everybody in? All right, let's take it down a little bit. So, you had a 1.27% down move today, helping pull that NASDAQ. You can also look at things like Facebook, which weren't as significant of downside moves, but they were definitely very volatile and showing red candles. So that was your worst performer, was the NASDAQ. Definitely lumps of coal in the NASDAQ stockings for that 7-day window of time. Now, oops, why do I always throw John O'Donnell? I don't know, I love John on the program. Next is S&P. So this is where it gets kind of tricky. For me, this doesn't make the cut because historically it's about 1.5%. We came out at 1.17 for the S&P 500, which to me does not put it in the Santa Claus Rally category. I'm sure some of you might beg to differ and say, well, we'll round up. Well, here is your S&P 500. And you can see really the 27th is what did it all. You had that huge move up on the 27th of December. And really for the past week and a half, kind of choppy, not the greatest candles. Although the good news for anybody who's bullish is volume is starting to come back in. You can see that right around the 25th, 26th, 27th, very low volume. And now we're starting to see it rally, move back up, meaning people are coming back to work and some more flow coming in. But John never haunts me. You never haunt me, buddy. Good to have you. Hey, Lee, good to see you too. Happy New Year to you as well. Got Sam Garcia in here, man. We got the whole crew. Got the band back together. And Alex, did you change your name, Mr. Mook? Good to see everybody. Ivsy, John, and Lee, Margaret, the regulars. Here comes Santa Claus. Well, this to me is borderline. I would personally say that this is not the Santa Claus rally because it didn't move up enough. But let's be honest, it moved up 1.17% in 6 days. I think by anybody's account, that's pretty damn good. We'll chalk it up. I'll concede we had a Santa Claus rally. So let's go and look at our next best performer, which was the Russell 2000, which was just slightly higher than that on IWM. Here is your chart of IWM, which I have not marked up like normal with the yellow boxes. The yellow box is actually further out. But you can see we've had a nice little run up, actually fairly decent move up to the tune of about 1.19%, just slightly beating out the S&P. And again, today, bringing back a bit of those gains down on the day, 0.15% for the IWM, but still 1.19%, pretty darn good. And the big winner, surprisingly, the Dow. The index I could care less about. The index that is such a narrow representation of our economy, in my opinion, with 30 different companies in it, blah, blah, blah. I don't know. That was your best performer by a good margin, and you can check out, maybe this is that flight to blue chips, the flight to safety and security. There is something noteworthy on this one, which I will point out here in just a second. You'll notice the move here. Overall, 2.18% for the Dow Jones Industrial Average ETF. Of course, futures could be, slightly different than this, but it's ballpark. So this definitely had your Santa Claus rally for the Dow. What's noteworthy here for anybody that's trading the Dow, I like it. This looks like a short opportunity. Why? Well, take a peek at the chart. You were at all-time highs, so you broke through this ceiling of all-time highs, right? We can see that there has, I'll put a little line here on the Dow, which I think this is going to be an interesting one for tomorrow. Maybe diamonds will be in play, DIA. Here is this horizontal blue line at 365.67, right? That's, of course, the ETF, not the index, which we can bring up the futures if you want, but I just keep it on IWM because this might present trading opportunities for you tomorrow. But you notice that we've been hitting our head on it. We opened up and sold off. We closed right at it. Today we get this jump, a nice gap up, and we have a shooting star formation after a very strong move. So this is something to keep an eye on. I guess you guys all know how I would trade this one. The low price for today on the diamonds, DIA, was 367.21. So I'll move this line up here to 367, just slightly below that. There's 367.21. Now, of course, my rule is if we open up anywhere above that blue line and then start to move down tomorrow, there's your short opportunity. You could get a gap fill and potentially even more, but some call this a bull trap where everyone's just very bullish, all-time highs, all excited. Yeah, here we go. And then all of a sudden, things come ripping back down. So just something to keep an eye on for tomorrow. You notice we don't really have that same pattern on the Nasdaq, right? That's definitely no shooting star. That's just straight up ugly engulfing pattern. You don't have it on SPY, right? You have, really, that's not any specific pattern other than it's kind of staying within that yellow box yet again. And then the other one we were looking at was QQQ, IWM. All right, there's your Russell 2000, which is not at the all-time highs, but drifting up. So the best day trading pattern I see for tomorrow is looking at that Dow Jones Industrial Average and see if that one... is there any single stock that is in three or three of the four indexes? Yes. That's a great question. I'll let you guys answer that one. How many companies are in the S&P, the Nasdaq, and the Dow Jones Industrial Average? I have to remember. It may have changed. Hey, Shinobi, good to see you, Brian. I'm writing them down here because I think. All right, I think I got them all. So what do you guys think? Name, or you can name them specifically, or just tell me how many are in all three indexes. The S&P, the Nasdaq, and the Dow. The Russell, remember, won't have them because Russell is small cap, so it really can't have that kind of overlap. You might have maybe some Nasdaq small caps inside of the Russell 2000, but anyway, and Happy New Year to you as well. So, and you get three, Shinobi knows it. Do you know which ones they are, Shinobi? They've been there for quite some time, and I thought there might be a fourth one, but I haven't really followed it. It's Apple, Intel, and Cisco are the three that are in all three major market indexes. Now, it's interesting because if you have, Apple, for example, is in Microsoft, you're right, so there's 4 now. Yep, there's 4. No, not Exxon. Exxon's not in the Nasdaq. So if you have, when you look at this, why is it important? I used to always focus on this because Cisco, for example, was in all three of the indexes. And I was like, well, this has much more weight because if Cisco reports bad earnings and the stock takes a dive, it could have a huge impact on those three indexes. But if you look at the weightings, Cisco is almost irrelevant in some of the indexes, like S&P, right? It's really important what the weightings are. Now, if Apple had blowout earnings, and either up or down, it has a much more dramatic impact on these indexes because it's such a heavy percentage. I don't know what it's now. It used to be 21% of the Nasdaq. I think it's lower than that now. As you say, Mark, you see the market movers. But remember, Cisco, even though it's still a major tech name, its weighting is really not that impressive. Let me go here. Just go QQQ weightings, and I always love looking at this stuff. I'm a geek, so you guys should check it out too. Nasdaq weightings. And there's a site called, where was it? It's called Index Arbitrage. Used to have it. Let me bring it up, see if I can bring it up for you guys. Index Arbitrage used to have all this stuff. All right, here you go. Maybe this will give you the percentages. So here's your top pieces. So Apple, about 11%. So Apple, Microsoft, Amazon, those are your heavy weightings. Tesla's at 4.5%. We could probably click on here and find a lot more. I don't know why it's not giving me all of them. But, once you look at Adobe, there's a huge name. It's only 1.98. You start to get some of the other names, it's very small. I mean, really, really tiny allocations to those positions. Unfortunately, I don't have the full breakdown here. Yep. Is it 50%? Wow. I knew it was heavy, but I didn't know it was that much. Really? Let me just go Dow weightings. All right. We can all geek out on stats today. So, that seems kind of weird. Components of the Dow, it's actually showing Apple is being number 12 on it, which is only 3.2%. Yeah, I didn't think it was that heavy weighted in one. You look here and you can see the weighting in the portfolio is 9% for United Health. Home Depot is 7%, which is kind of surprising to see Home Depot that part of a lead. Remember, one of the big things with the Dow is it's a price-weighted index. So you notice anything that's got a real high price tag obviously is a greater weighting. So when you have something like Apple doing a split, that changes dramatically its impact on those indexes. And I'm not exactly sure how that worked because, Apple did do, I think it was a 4 or 5-to-1 split last year. Obviously, that impacted the price dramatically. But there you go. You look down here at the end, and you got Verizon. It's less than 1%. Well, there's only 30 companies in there. So in theory, everything should have a weighting of about 3.5 or 3 1/3%. So a lot of these are real weak. Cisco is only 1.13. There's your Intel is less than 1%. So these guys aren't that important. But then we move up here to like Microsoft. There's Microsoft is 6%, number 4 on the list. And you have Apple at number 12 because of the recent split at 3.2. So those two companies, Microsoft and Apple together, getting around 9.2, 9.3%. Yeah, so sometimes, Tom, I think the maps skew the visual and make it look like they're bigger because I don't know whether it shows the weighting of that, but I like to look at the actual percentage. But Big Eb says Amazon is going to split 10-to-1 soon, in my opinion. I agree. And so what would that do to Amazon's position in some of these indexes? Well, it's not in the Dow, right? But if we look at, let's say, S&P weightings, which S&P is not I don't believe S&P is price weighted. I forget how they do the weighting in that one, but it's not the same. Dow is a little bit more biased just towards price, which can be completely misleading. You guys understand that a stock could have a very high price and just not have very many shares out there, so the market cap doesn't necessarily have to be that big. But think about how much tech requires either Microsoft or Apple to work. Yes, I know Android. Yes, I mean, absolutely. I mean, I look, I'm not saying that Apple and Microsoft aren't critical, but we don't see the over heavy weightings, right? 10% should be about the most. Now, here's where it's kind of weird. If you look at the Dow, remember, this is 30 components. So you have 30 components here, and one of those is 9%. That's pretty heavily skewed, in my opinion. If you look at, let's say, S&P 500 weightings, hopefully I can get this one. Click CliK charts. There you go. Notice Apple as a commanding lead in this one, almost 7%. So Apple and Microsoft together equal about a little over 13% of 500 companies. That to me is, starting to get a little bit biased. And you look at the lead here with regards to S&P. Remember, this is supposed to be the most diversified representation of our markets. You've got Apple, Microsoft, Amazon, Tesla, Google, Facebook, and Nvidia. I mean, your top 8 are just nothing but tech. So, you wonder why these markets have been doing so well. You look at something like XLK, which for the longest time has been just vaulting these markets higher, especially since those bottoms we saw in 2021. How much was it up? We're up roughly, just give me a little second here to look at the numbers. We're up roughly, 155% in XLK, whereas you look at something like SPY, we're not up those levels yet. I can get rid of that. We can go here to the lows. And you got 108. So tech definitely bringing this whole segment to the upside. But something to keep an eye on, the Nasdaq weightings, at one point they were completely out of whack, giving over 20% to Microsoft. And I remember having this discussion with John O'Donnell and some others on Power Trading Radio of, this is really dangerous. Like, you should not have one company with that much pull, because if something happened to, Tim Cook, the CEO, gets in a car accident and dies or something, and all of a sudden the stock drops 30%, buy some Apple, because it'll probably still do fine, but that knee-jerk reaction could create a much bigger landslide in our financial markets. So to me, it's a systemic risk to have anything over even 10%. I think is getting a little bit risky. In the Dow, it's okay, but when you have something like the S&P, which has 500, everything there should be 0.2%, right? I mean, if you take 100 companies, they should be 1% each. If you take 500 companies, they should be 0.2% each, and some of those are running around 6%. That's a little bit crazy bias. Okay. Anyway, my rant is over. Santa Rally over, crash it. There you go. You're done with it. There's another mantra which we'll look at the end of the month, which is as goes January, so goes the rest of the year. Nope, I haven't purchased any puts yet. I wanted to, Big Eb. Yesterday I was thinking about it, and I'm like, you know what? I'm a little gun shy. It seems like the first couple the last few times I've taken short positions, I've been smoked on those options. So nothing yet. I'll let you know as soon as that does happen. But I really wanted to do it. But so here's our final piece here. You've got as far as results, I'm calling the Dow as Santa Claus Rally. For the other three, not quite enough. You had to get over 1.5% in my opinion to be a Santa Claus Rally. So there we go. For your Santa Claus Rally. OG, but Nancy Pelosi bought a bunch of MSN calls. Did she? No. See, the problem with that, though, is when did she buy those, right? Most likely those reports that you're getting about anybody's disclosure from any senator or anybody, congresswoman, whatever, they're delayed. They don't have to report in real time. For example, there's a, I think it's called Guru Focus. Anybody ever use Guru Focus or look at it? Let's see, I actually like this site. Again, don't pay for anything. Don't pay for anything on these sites, but here is a Guru Focus, right? And if you put in here Warren Buffett, right, so you can just go Warren Buffett. You can see his portfolio holdings. So there's all of his portfolio holdings. Unfortunately for us and for almost everybody in the world, you won't know what these are until they are reported, right? So here's this full list of holdings. It does a really cool, used to do like a little heat map. You can see right now most of it's technology, very heavy weighting in technology. You got biotech, royalty, pharma. He's got a new holding, so he's just buying Floor & Decor. That's kind of weird. He's buying Floor & Decor and new holdings in Royalty Pharma, PLC. You can see his huge Apple position here. I mean, it's $125 billion worth of Apple. That's crazy to think he's got that much. He's got 887 million shares. Anyway, nice to see their holdings. But remember, these won't be reported until the quarter's over. So after the quarter's over, he will disclose what position. So you never know exactly how, when Nancy bought those options. If she did, in fact, buy them, they may actually have been bought and exercised already because there's a quarterly reporting. Again, I wish that there was a way for us to make it where as soon as she makes it, as soon as anybody, let's not say she, as soon as any elected official makes a transaction in the financial markets, it should be real-time data. I'll give them an hour head start, but there should be a blockchain that reports all their transactions immediately to anybody who would like to see that, because I think it's a conflict of interest for them to be buying and selling securities when they're voting on important issues like infrastructure bills and who gets that money. I mean, you guys all know right now that anybody who's on Capitol Hill is going through and saying, okay, we're giving away $200 billion to building new bridges. Which companies? Because I'm buying those before the public knows. That's the real world way these markets work, unfortunately. Insider trading at the highest levels. Mark says, what's the difference between A and C Googles? Good question. So, look here. I forget which one it is, but one of them, when they did this split, one of these shares has voting rights. The other one has no voting rights whatsoever. So I believe Class A, G-O-O-G, let me take that back. I think Class C has voting because that's the original ticker symbol is G-O-O-G. So Class C gives you voting rights, meaning every time they have a voting, you can vote for whoever you want in the company. G-O-O-G-L, I believe Class A shares do not have any voting rights whatsoever. That's the big difference there. All right. It's kind of weird that they did that. They were trying to, split it off, I guess, and just kind of take some of the keep control for themselves and have new people come in, but they don't get the ability to vote. That's the way they did that. Yes, exactly, Owen. Insider trading and no jail time. It's really befuddling to me that happens, because if I were to do that and get caught, I'm going to prison. I can go to jail for insider trading and some of the stuff that these guys are all legally allowed to do. Kind of crazy. I agree, Alex. Athletes cannot bet on games. I still think that one of the greatest players to ever play the game should be in Canton, regardless of his betting. Pete Rose, he bet on himself to win. If he ever bet for the Reds to lose, I understand. But he bet on them to win. Hey, let him go. They won. Anyway, I'm going to get my political side out of here. But yeah, they should throw lawmakers. I agree. Totally agree. Congress front runs all of us. Yep. What are you going to do about it? I mean, what can we do? The only way this will change, people, is if they vote to make it illegal for them to do that. So let me get this straight. I'm an elected official, and I literally own the goose that lays the golden egg. I am responsible. I'm on some subcommittee, the banking subcommittee or infrastructure or homeland security, and I can now vote on issues which will benefit very clearly one specific company or market sector or the overall economy, or maybe even push it down. And let's say I'm looking at credit card reform. And I'm Nancy Pelosi. Of course, Nancy Pelosi took advantage of credit card reform, got some Visa stock given to her and her husband, and made a bunch of money off that. But what if she knew that she was the deciding vote and going to vote against credit card reform? What do you think would happen to Visa? Right? If there was mandatory credit card reform, Visa, MasterCard, American Express, Discover were all going to get slaughtered. Well, she could have gotten short those companies and it would have been legal. Crazy. Jimmy T. So Martha Stewart was guilty of insider trading, but that's not why she went to jail. She went to jail for purging herself under oath. So, kind of funny. She did do insider trading, and she probably would have gotten a fine, little slap on the wrist. But because she perjured herself in a federal court, that's why she went to jail. It was not for insider trading. Yeah, it's funny. Martha Stewart has done more jail time than Snoop Dogg. It always just cracks me up every time I say that one. Let's see what else. Tom says, CongressTrading.com lists the trades made by elected officials. Usually they show up a month after. Okay. Well, I mean, at least you get an idea. I mean, if Nancy Pelosi or Schumer or, you name it, it's not to make them Democrat or Republican. Again, it's not polarizing politics. They're all doing it. It would be interesting to see if that was real time. I would probably be following that portfolio myself and just buying. Every time I saw Pelosi buy or Schumer or whomever buying, and I knew they were on a committee, I'm in. Yep, exactly, Margaret. All right, let's shift from there because we're all going to get depressed on the whole political side of things. We don't want to be depressed today. All right, so I was asked to capture this yesterday, and I agree, Tom. I think this is a good one. So I wrote down everybody's that I could find. I also put myself on the list here, and I put my my call for silver and that 10-year treasury, just so we have that here. I will, I'll keep this for the end of the year. It's actually I already have the December 31st show, a folder created, and we'll see how that ends up. But there we go. I think there was a one discrepancy. So Koja, you said 18%, so I earmarked that off the current price from the open of the year, which would have been 56.20. Everybody else, you got your numbers on here. So there we go. We will show you that one at the end of the year. And I wish I had the monetary basis to give a prize to whoever gets the closest. We should say the closest without going over. But maybe I'll get sponsorship from somebody down the road. Who knows? But anyway, there you go. That's your list for calls or on the S&P 500. If there's other people in here that wanted to give their estimate and be part of this one, why not? Let's have some fun. There is, in my mind, there is no real right or wrong answer, because you could be wrong on guessing the forecast of the market for the end of the year, but could have been made a ton of trades that all of a sudden put you in a very profitable position, regardless of if it did what you thought it was going to do or not. So if you want to make it easy on me, because if you type in the chat, I might miss it, but if you want, you can email me, go to TraderMerlin@gmail.com, put in your forecast for the S&P 500, and I will add you to this list. You can either do it through the Gmail or just comment down below the YouTube video. You can just say, I think the S&P is going to be this number. I'll add you to the list, and we'll have some fun with that one. Okay, that is that. Wasn't that such a great level? For those that might not know, he's not being demonic out there with his 666. That was the low point of the S&P 500 back in 2009. 666 on the S&P 500. Boy, Shinobi, if you're right on that one, that we hit that by the end of the year, we close at 666. It's going to be a really ugly year. I hope that doesn't happen. That would be catastrophic to our global economy, and certainly a lot of people. I think most of us would probably enjoy that as from a selfish perspective, right? If the markets drop from our current levels to 666, yeah, we're at 4,700. It means we dropped 4,100 points. Boy, there's going to be a lot of people that lost all their retirement. They're going to be out of work. The economy is going to look like crap. But as traders, we could actually be capitalizing on all that. But let's not be selfish here. Let's hope that it moves. All I want is movement this year. I don't really want to have that much of an apocalyptic move in the market. But hey, if it does, I hope that I got my 420 puts on by then. All right, so Frank, you sent in this one, and I apologize for not getting to it sooner. Frank says, began shorting IWM using some March puts. If we break above 22.75, I will close for a loss. Target is 21.50. What are your thoughts? Unfortunately, I think you're already out, Frank. I don't know if you're here. Let me know if you're here and out of that one. I'll zoom in here so we can kind of play with the most recent data and take this bad boy off the screen. And there is your chart. So, when you were looking at the IWM, you quoted the IWM, but then you bought puts on it, but you're also looking at the RTY futures. So here's your RTY, and if we look at the numbers you were talking about, here is your stop loss, which was 22.75. And I like it. There's just one little problem for me, which is you didn't incorporate the tails. So I think you sent this one yesterday or 2 days ago. If you sent it in here, right, let's say you were shorting, and you were going to use this 22.75, which is the top blue line, as your stop loss. For me, I would not have done that. I would have moved it up higher. So you can see this high that we had on December 8th. Now, and you also peaked back here on November 29th. So I would try to incorporate those in. And if it doesn't make sense from a risk perspective, meaning that stop loss might be too big, then just drop the number of put contracts that you're buying, or reduce your share size or whatever to accommodate for a wider stop loss. So I would have done it like that, and of course, just full honesty, I'm not lying here, but I would have been above those peaks, which would give me somewhere around 22.84. However, today's action would have taken me out regardless, right? So I'm not sure if you're still in it. Your target area is at 21.50, which is back down here, which I think is fine. It's like we're starting to form another sideways channel within this bigger sideways channel that we've had, right? Just kind of maybe not making all the way back up to those highs. Maybe we, narrow this box down, just for an example. Don't freak out, Tom. But if I bring this down to here, you can see that at least for the past month, it's all of a sudden respecting a narrower range. I'm still going to keep it up here because I like this box better, and it's been there for freaking ever, it seems like. Anyway, 21.50, I like the target. the stop loss, I would have just had a slightly wider one, Frank, just because I want to incorporate in those tails that we just mentioned. That said, you would have been stopped out regardless, all right? If you're still in it, I think you still use this 22.85 mark as your stop loss. All my puts are in for 470 on the SPY. Richard. What time frame, Richard? I mean, how far out are you going? So 470. So you bought 470 puts? You probably pay a pretty good premium for those. And this is where you really have to do, I guess, your own personal analysis of it. Because one of the things I like to do with puts is I like to go, if I really think we're headed for a sharp slide, which I think is probably going to happen in Q2, then I would probably have bought deeper out of the money. If you bought this, and let me change the color line. You said 470, so I'll put that right there. We'll make it red, just so we can all see the difference here. Okay, so the red line is your 420. You're paying a pretty good premium for that, right? And there's nothing wrong with that, but sometimes I think that the rate of return that you get by going deep out of the money can be much higher, especially if you get a sharp knee-jerk reaction. So, the cost for a 470 is probably fairly expensive, but how much would it cost me to get, let's say, 450s? Right, that's the one it seems like inconceivable that would get there in a month. Or of course, I wouldn't be buying options with 1 month of time premium. I'd be going at least 3. But if 3 months, this is definitely doable. And I would always just kind of run through and see, at least for myself, where's that premium going to be? Because if you sold the 470 or bought the 470s versus the 450s, if it fell, you'll probably make a nice rate of return if it fell to 470. But depending on how quick it happens, all of a sudden when this thing falls fast, people gobble up those out of the money puts because they start to panic. And all of a sudden the premiums spike on those, which I've been lucky enough to have capitalized a few times over the last few years when there's fear in the market and all of a sudden things really start to tank. People are like, oh crap, I got to buy some puts. And they go out of the money because they think it's going to continue. And lo and behold, the markets have been bouncing back up. So that's kind of how I would do it. I know you have the 470s, but I'm not quite sure exactly your time frame. Certainly 90 days, 470 is extremely doable. Hell, it could hit 470 by the end of next week, in my opinion. It's not going to take much. That's only 1 or 2% away. Let me see exactly what that percentage line would be. So from current levels, you're literally 1.13%. That's nothing. Drop in the bucket. How far into expiration would you do if day trading these options? If I'm day trading, I don't really care about time. I want to make sure that the spreads are tight. I've only day traded options a couple of times. I don't know, not really my thing. But the further out you go in time, the wider those spreads will get, right? So sometimes you get a very wide spread. Certainly if I'm day trading or when I day traded, I would do very like the most liquid things, SPY, right? I'll do SPY, I'll do QQQ, something that's extremely liquid, so that if I do buy and sell rapidly, the spread doesn't kill me. Because you start doing limit orders as a day trader, it takes a lot longer to input all that information rather just hit markets. And if I'm giving up that, I can't give up a big spread. So I don't really care about if it's 30 days, 90 days, even intraday on options, because if you're a day trader, you're going to be out in a very short window of time. So I'm okay on any one of those. Generally, the shorter time frame you're going to use, you get more volatility because you're coming near the end of that contract expiration. But that means for you more risk with that specific option. I feel bad, John, because I don't really focus on delta. I'm more looking at the price chart. I'm saying, what are the probabilities of us getting down to this level? That's usually how I'm determining it. I don't really use delta. I know I should be ashamed of myself, but that's just... do I ever buy calls? Yes, absolutely. When the market permits, absolutely. I'll be looking to buy calls. Yep. Right now, buying calls to me in this market environment is... The odds are better because the trend has been up, right? However, at a certain point, the probability starts to shift that we're going to have a pullback. And I think we're ready for a pullback. I don't think it's going to be a major one yet. I think we'll get a pullback and then another rally back up until we get the Fed stepping in and saying, hey, we're going to do whatever we're going to do with regards to rates. That, to me, will be the killer. When does that happen? Well, that's obviously going to be a bit further down the road with regards to those specific announcements from the central bank. This week we have, on January 5th, tomorrow you have the FOMC meeting minutes, which I think is going to be very important. But the next major rate announcement, you got a ways to go till you get there. Right now, I believe, if my memory serves me correct, it's the 26th of January. So it's going to happen this month, the Fed funds rate and the press conference. That could be a huge thing, right? we know that tapering has been accelerated, and the reason they've accelerated tapering is so they can start to raise rates. If they raise rates, and they won't do it January 26th, if they raise in January 26th, that means we have a real problem, like a significant problem. I don't think it'll happen. It'll be the meeting after that. So, those are pieces I think are looming. They're right around the corner, and when we look at those markets, to me, that's the major piece that's going to be pressing this market in whatever direction it decides to go this year. But I think that the Fed meetings are probably the most important things that we should be looking at. The meeting after that. So I think you have January 26th. They meet every 6 to 8 weeks. So let me find you the exact date here. I think it's in early March. Yeah, so March 16th is the meeting where I think we'll start to see rates increase, or at least a much greater talk track to that extent. All right. Sean Reed, OTA instructor. Yep, Sean Reed's awesome. He's only been on here one time. He's kind of this, I know, disrespect the Greeks, Alan. It's not that I disrespect the Greeks. I'm just lazy. I actually respect the Greeks. I've got a fresh, nice, gorgeous bottle of ouzo straight from Greece. Don't disrespect the Greeks. How can you disrespect dolmas and Greek salad? The only confusing Greek to me is Vega. Vega is definitely a confusing one. I don't know. I guess I keep it more simplified, and I believe I could probably do better with my rates of return on options if I did pay attention more to the Greeks. But again, for me, I'm just going to go out here and look at this price chart and say, where do I think it's going to probably go in the next 3 months? Do I think 450 is logical? Great. Then maybe I'll go just below that and buy the something that's going to be out of the money at that moment in time. But I know, strange the way that I do things. Me, they're just supply and demand and price action, right, NJ? Your put trades anticipate negative spikes. Sean Reed teaches to go deep in the money, like 80 delta. Wow. Yeah, that's not my strategy, and that's okay, right? There's so many different things for everyone to look at and to do in the markets that awesome. And Sean's awesome. I really like Sean's strategy. What's his core? Is it peddling for premium? I think that's pretty much what he is. He does a lot of cool things where he actually charts the spreads and splits spreads. I thought that was really cool. So Manuel, I think I may have answered this one in the past, but I guess I can piggyback on it. Is looking at fundamentals important when deciding on an options trade? I see penny stocks have options and terrible fundamentals. Look, I personally don't think so. So remember, my rules are this. If I'm buying options, if I'm buying puts or I'm buying calls, I'm looking for a 90-day window of time. Over that 90-day window of time, there is a possibility that I'm going to go through an earnings season, right? That's about the only thing that really freaks me out. Other than that, I don't care about book values or PE ratios or any of these fundamental pieces. They don't matter to me. I'm going purely off of supply and demand. If I'm doing leaps, and I'm going out, let's say, 2 years on something, yeah, I think I should probably pay closer attention to some of the fundamentals as a buyer. As a seller of options, I don't go more than 30 days, right? 30 days is my max. So for me, I don't care what fundamentals are. I could care less. Again, the only thing that really is dangerous is earnings. So I'll ask you guys this. What do you guys think I do to help mitigate the risk of earnings? So my goal is to reduce risk as much as possible. So like the 1% account I was telling you about, and there's a whole lesson for those who might be new. I did a show you can search for called, I think, the 1% per month trade strategy or something like that I posted last year. I could go out there and I could be selling puts on Tesla or Apple or Intel or Microsoft. But all of those are going to have earnings seasons, and I could get absolutely screwed on those trades based off an earnings play. So the way that I'm avoiding earnings, Margaret, is I'm actually letting earnings happen. But all of those trades that are in that portfolio that I talked about, the 1% strategy, they're all ETFs. They're exchange traded funds. So I'm going into SPY, QQQ, XLE, XLF. So yeah, Cisco may report earnings. Who cares? There's 500 other companies in that index. So the risk factor gets reduced. And I know that some of you are like, well, I want the bigger moves. I want the volatility. And that's fine. Mark says drink heavily. That doesn't reduce my risk, Mark. That actually would increase my risk. So, that's one of the rules in that 1% account is it's got to be an ETF or a commodity like gold and silver because they're not going to report earnings. Now, there is some seasonality, some reports that may be issued on gold and silver, but for the most part, I stick with ETFs. And guys, I think I showed you over here. I actually added it to my watch list. These are some of the main sectors I look at. You notice they're all the spiders, right? You've got. Oh yeah, no, I don't drink heavily. I drink lightly on Fridays. Yes, Friday is my drink day. That's to celebrate the weekend. But I love this because I sold puts on XLE. Great. And my puts, I believe, are down here at 49. I got 1% premium. And now what you're thinking, I know what some of you are thinking is, well, why didn't you just buy XLE? You'd have made a lot more money. I'm not concerned about that. I'm not, this specific account, I could care less whether this thing moves up. I just want to collect my 1% consistently, like basically hitting base hits as often as I possibly can. What was the other one that I went into? It was XLE. I think I did IWM as well. Same thing. Right around the same time, sold puts on IWM, and you can see my strike price down here is 187. That's for January 22nd. Do I really think it's going to get there? Probably not. I mean, the odds are pretty slim that's going to get down there in a little over 2 weeks. All right, we've got 2.5 weeks for IWM to fall. How much is that? 16%, 17%? Not going to happen. I'll collect my 1%. And while somebody held IWM long, you would have done okay. But what happens if IWM falls at 205, 201, 197? You're losing. So that's the reason that strategy is in that account. It's ETFs. It's diversified. All right. Let's see. NQ and ES weren't moving together. I avoided trading equities all day. Well, sometimes they don't have to move together. This was actually one of the things I focused on a lot back in the late 90s, and I was a hardcore day trader, was what is moving, right? And I'll walk you through. John, I don't. Not for any real particular reason. If you're day trading, so John, for the podcasters, John asked, do you trade leverage ETFs? So you're looking at things like, FAS, FAZ, the SDS, QID. These are sometimes double, sometimes triple leverage ETFs. There's a huge problem with those. If you hold a triple leverage, either long or short, and that security even does what you think it was going to do, you will lose money over the long haul because of this decay. It's the way that these leverage ETFs are structured. So if it's a long-term hold, absolutely not. You should not be holding them in your long-term portfolio. As a shorter term, yes, awesome, right? Short-term trading, you can use that triple leverage. That's great. Just remember, the more time you hold that security, the more value it's just slowly eating away at that price. For example, if the S&P, I'm using a number. Let's say you bought a triple leverage ETF and the price was 100. The next day it falls to 50. That's a 50% drop. Well, you probably margined out because you're at 3-1. But how far does that have to move up to get back to 100? Right? It went from 100 to 50. How far does the gain, or what is the percentage gain that security needs to have to get back up to even? You can fall 50%, but it would have to move 100% to break even. There's part of the problem. There's a little, every time that happens, for a move up or down, it'll chip away a little bit at that calculation. Anyway, I could do a whole show on that. It's pretty awesome. How do you measure your strike price on those ETFs? Supply and demand. That's the only way I'm doing it, Serge. So basically, I look out here. So for the Russell, I forgot exactly the day. I think it was, I'll put a horizontal line here. I think it was right back in here. So I pretty much got the bottom. I think it was this green candle right there. Yeah, because it was on a Friday. So it was somewhere inside of this. Let me get the volume off here. Somewhere inside of this green candle right here. I don't remember exactly where. And what was I doing? I was just saying, well, look, where can I get 1%? And 1% actually ended up being down here at 187. Now, I could have probably gotten a little bit better rate of return by using the 193s, something a little bit higher up, and using this area over here as demand, right? But I was like, I don't really care. I'd rather just have my 1% and know that there's pretty much no chance I'm going to get executed, right? Same thing on that, XLE, XLF. There are times where I'll get executed in that account, but it's fine, and put those options, or put that security in, it's fine. So there you go, Serge. All right, 44. All right, I got to wrap things up because I have a crypto session I got to do tonight, and I have a lot of preparation to get into for that one. I was actually, once I finish the CIL program tonight, I was actually going to put them on my list to contact some people and see if I can get some guests on the show at least for the remainder of the month, get some people on there. I know we've got a few of you who have been asking about specific people. I saw someone asking about Jeff Manson. I saw David Warner. Let me know who it is that you'd like me to get in the program. I actually want to get Don Fraun on the show as well. I know we've got some people here who are probably have come over from Don's site, so we'll see if we can get him back on the show. If there's somebody you want me to bring on, I will do my best to reach out. I've been really lazy about that, but you can email me at TraderMerlin@gmail.com. Let me know who it is you'd like to see on the show, and I'll do my best to get them on. Jimmy T says, have you ever bought leaps and sold monthly puts? I have not. The rubber ducky. Oh, yeah, we'll get Sam on the program. I told you that scumbag will never be on my show. Ever. I love the fact that I have that power. He will never be on the show. Saminsky. Good one. Dr. Woody. Okay. I'm sure I haven't talked to him in a while. I just got an email from Saminsky as well. All right. We'll do it. Yeah, Dr. Woody would be great. And again, if you guys see, what I'll try to do is put them on the calendar. If you see that there's somebody coming up, and of course I'll tell you who's going to be coming up, email me in questions and let me know kind of what things you would like me, or how you'd like me to direct that conversation. Because I always have questions for myself. Oh, Sam Evans, yes. I thought you meant he who shall not be named, the Voldemort of the trading world. Yes, Evans. I haven't spoken to him in a while. I need to wish him a happy New Year anyway. Evans. Awesome. Cool. Yeah, it's been so long since I've had these guys on the program. Yes, no, Sam Evans is great. Marty Bent. I don't know Marty Bent. I know Marty Dim. Marty Bent. Oh man, you're adding all kinds of names of people I don't know. All right, Marty Bent. It is. We'll see what he says. And Bob Chino. All right. There we go. I got a Todd Davis. You know what? Todd Davis, I have tried to get him on mic. He is awesome. He's one of my favorite people. He's just a great mind and a good person. Problem is, he's so busy and he's really shy, believe it or not. He's like, I don't know if you've ever taken a class with Todd. He's epic, but for some reason, like interviews, he just doesn't like. If he can be in a forum where he can just go and do his own thing, he's great. But Sean Kim. Oh, man. I traded with Sean Kim years ago. Love that guy. So fun. He's got some stories, man. Oh, boy. Sosnoff probably won't come on the program. He'll just shrug his shoulders at me and go, eh. I interviewed him years ago. Very nice guy. I actually like Tom Sosnoff a lot. I like he's a straight shooter and he just does not give an F about anything except what he's doing. Okay, great. Do what you got to do. And McCormick. Okay. All right, apparently I got a bunch of phone calls to make. I got a huge list here. So I will do my best to get more people on so I don't bore you to death with just me. That said, I will obviously continue to do shows with you. But that's it for today. If you guys have questions, TraderMerlin@gmail.com is the easy way to get in touch with me, or put comments down below the video. Like, share, do whatever you got to do. Bring some new people to the show, whatever it takes. That said, have a fantastic remainder of your day, everybody. I'll see you on our Wednesday session.